Imagine it is November 7th, 1923. You are a 47-year-old schoolteacher living in Berlin, Germany. Your name is Heinrich. You have been teaching mathematics at the same secondary school in the Schöneberg district for 22 years. You're respected. Your students call you by your last name with something close to reverence. You live in a clean, 5-room apartment on Hauptstrasse with your wife and 2 daughters. The apartment cost you 18 years of careful savings and a small mortgage, and you paid off that mortgage in 1919. You paid with money left over from the war bonds you had bought to help your country during the fighting. On your desk, there is a thick folder containing documents you have kept in perfect order since 1901. Inside that folder is a 20-year life insurance policy, 3 sets of government bonds, and a savings account passbook. The passbook shows a balance of 64,000 marks, and there is a pension certificate from the Prussian State Civil Service. You are, by every measure available to you, a man who has done everything right. You have worked hard. You have saved. You have invested in the instruments your government told you were safe. You have trusted the system. On November 7th, 1923, all of that paper is worth less than the coal dust on your windowsill. If you have ever looked at your savings account and thought you were building security, stay with me. If you have ever wondered why financial systems that look solid can simply dissolve one morning, listen carefully. What you're about to hear is not a theory. It is a pattern. It has happened before in prosperous countries. It has happened in sophisticated cities, to careful and intelligent people who did everything the right way. It always ends the same way for those who did not understand which 5 things become worthless when an economy collapses. If you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead. Because here's the brutal truth about Heinrich's situation. It was not bad luck. It was not incompetence. The 5 things Heinrich used to build his financial life were the 5 things that history proves most fragile. Again and again, across more than a century of economic catastrophe, these items fail. Not the riskiest investments, not the speculative gambles, the most ordinary, conventional, responsible things that ordinary people build their lives around. That is the part that makes this story so difficult to hear. That is also the part that makes it important. Today, we are going to walk through 5 of them, not with warnings or predictions, but with history. With real numbers, real dates, real people, and real consequences. The historical record is not ambiguous, and once you see this pattern, you cannot unsee it. There is something important to understand about why this happens. It is about the mechanism underneath all of it. Most people think of economic collapse like a building falling down. One moment it is standing, the next it is rubble. They assume something dramatic like an earthquake happened. But that is not how economic systems fail. Economic collapse is not a building falling down. It is a river changing course. The river does not suddenly jump out of its banks one Tuesday afternoon. The water has been eating the soil for years. It happens quietly, underground, invisibly, while people walk along the banks and say the river looks fine to them. The mechanism is almost always the same. A government or banking system accumulates obligations it cannot actually keep. Those promises are backed by paper backed by faith, and faith backed by nothing except the belief others will keep believing. For a long time, that is enough. People trust the paper because everyone else trusts the paper. Banks trust the bonds because other banks trust the bonds. Citizens trust the currency because their neighbors trust it. The whole structure stands not because it is made of stone, but because everyone agrees to pretend it is made of stone. Then one crack appears, then another, then the pretending stops. When the pretending stops, things do not slowly sag. They fall through the floor. This is the root mechanism behind every case study we are going to look at today. Understanding this mechanism is the key. Every single thing on this list is a piece of paper or a promise. It is a number in a ledger that derives value not from what it physically is, but from what it represents. When that agreement breaks down, everything built on it breaks down at the same time. That brings us to the first thing. It is the one that shocks people most because it sounds absurd. The first thing that becomes worthless is money itself. Specifically, the cash savings that ordinary people spend decades accumulating in bank accounts, under mattresses, and in passbooks. The thing that every financial advisor and every parent has told you to build and protect as bedrock security. In Weimar, Germany in 1923, a man named Maximilian Bern walked into his Berlin bank to withdraw his life savings. The account held 100,000 marks. In any earlier period of his life, that would have been a fortune. It would have been retirement and security for his children. But this was November 1923, at the peak of hyperinflation. Hyperinflation means prices rise so fast that purchasing power collapses faster than people can spend their money. Maximilian Bern took his 100,000 marks and he bought a single subway ticket. That was it. He rode the train around Berlin one final time, returned to his apartment, and according to the record, starved to death. Stop and sit with that for a moment. 100,000 marks, a lifetime of savings, 1 subway ticket. By November 1923, the exchange rate between the dollar and the mark reached 1 trillion marks to $1. Not 1,000, not 1 million, 1 trillion. A loaf of bread cost 200 billion marks. The Reichsbank had its printing presses running through the night and still could not produce enough paper for the demand. Workers were paid twice a day so that they could spend their wages before afternoon prices made them worthless. A factory worker described payday as a scene of controlled panic, running to the nearest shop before the prices changed again. Cash savings did not just shrink in Weimar Germany, they were obliterated. Every mark printed before that month became worthless. Economist Thomas Sargent found that by October 1923, 99% of marks in circulation were printed that same month. But Weimar Germany is not a unique case. It is not even close to unique. It is a documented process. This process has replicated itself with consistency across the 20th and 21st centuries in many different nations. In Lebanon, beginning in October 2019, a banking crisis froze the accounts of nearly 2 million depositors. People who spent careers building savings in a sophisticated banking system found themselves unable to withdraw their own money. The Lebanese pound lost more than 98% of its value over the following years. Families watched security dissolve. Some depositors, driven to desperation, walked into their own banks with firearms in 2022 to demand their own funds. The pattern in both cases is the same. The savings were not spent or stolen by a thief in the night. The account numbers were still there. The passbook still showed the balances. But the value represented simply evaporated. Because what a number in a bank account represents is not a physical object. It is a claim and a promise. When the system making that promise breaks down, the claim becomes unenforceable and the paper becomes empty. If you were one of the depositors who built your life around savings, what would you have done differently? Drop your answer in the comments, seriously. What I am about to show you next changes how you think about safety. The second thing that becomes worthless when an economy collapses is government bonds and fixed income instruments. A fixed income instrument is simply any investment where someone promises to pay you a set amount at a future date. Government bonds are the most common example. You lend money to the government, and it promises to repay with interest. In normal times, these are considered the safest investment in existence and the bedrock of pension funds and insurance companies. The reasoning seems airtight. If a government can tax its citizens and print its own currency, how can it fail? The answer is very easily. History has demonstrated this regularity with facts that should make bondholders deeply uncomfortable. Return for a moment to Heinrich, our Berlin school teacher. Among the documents in his folder are war bonds. In 1914, the German government ran an enormous campaign encouraging patriotic citizens to buy these war bonds. Ordinary Germans bought billions of marks worth of bonds. Widows, teachers, factory workers, and shopkeepers participated. They were told it was their duty. They were told the bonds were safe and Germany would win the war. Germany lost the war. The Treaty of Versailles in 1919 imposed catastrophic reparations the government simply could not meet. To service these obligations, the government began printing money. With each wave of new money, the purchasing power fell. The war bond Heinrich held paid its face value in marks, but by 1923, those marks could not buy an egg. This is what economists call inflationary default. A government breaks its promise by changing what the payment is worth. Argentina took a more direct route in December 2001, facing a debt crisis beneath a surface of apparent prosperity. The government enacted the Corralito, which froze bank accounts and restricted withdrawals to just 250 pesos weekly. The country defaulted on roughly $100 billion in sovereign debt, the largest sovereign default in history then. Bonds that pension funds and ordinary savers bought were now pieces of paper backed by a country that could not pay. Then came the pacification, the forced conversion of dollar accounts to pesos at an official rate invented by the government. Depositors who protected savings in dollars saw balances legally converted and watched those pesos immediately lose half their value. The fixed promise turned out to be entirely negotiable. It was as negotiable as the government needed it to be. Most people will never know what you now know. They keep trusting instruments they do not truly understand. Hit subscribe, because the next section turns what most people call a financial education completely upside down. The third thing that becomes worthless is life insurance policies and pension promises. This carries deep emotional weight. Life insurance and pensions are compressed decades of sacrifice. They are the belief that giving up today protects tomorrow. In 1903, a Berlin lawyer's father took out a life insurance policy and made premium payments faithfully for 20 years. He never missed a payment or spent the money elsewhere. He deferred gratification as responsible people do for decades. In 1923, the policy matured. He cashed it in. With the accumulated value of 20 years of payments, he bought bread. He bought one loaf of bread. There's a specific cruelty in that fact that goes beyond the financial loss. The deeper cruelty was the betrayal of the logic that had governed his life. He had done the right thing. The system did not just fail to reward him, it punished him with a precision that bordered on malice. The mechanism is the same. Life insurance policies in that era paid out in marks. The mark amount was fixed. The insurance company did not promise a loaf of bread, it promised marks. The marks became a number, meaning nothing. Pension funds follow the same logic. You give a portion of income today, they promise income in your old age. That promise is only as strong as the system. In the Soviet Union in 1991, the ruble went into free fall. Life savings accumulated over decades and state accounts were not seized, but they became worthless through inflation. Soviet citizens watched retirement funds become insufficient to buy a week of groceries. The money was still in the account. The number was unchanged, but the number no longer connected to anything real in the outside world. Greece in 2015 showed the same mechanism. As they negotiated debt, pension payments were cut repeatedly for retirees. Greek pensioners saw payments reduced by 40 to 50% because the system no longer had means to keep promises. Germany 1923, Soviet Union 1991, Greece 2015. In each case, the promise was made in nominal terms. The promise was kept technically, but the number had been drained of meaning before the payment arrived. Paper promises built on faith fail when the system loses ability. Collective belief does not crack slowly, it shatters. The fourth thing that becomes worthless is leveraged real estate, specifically property purchased with borrowed money. When deflation takes hold, property value can fall faster than the debt secured against it. Millions found themselves underwater. In Japan, after 1991, commercial property prices fell by 80% over a decade. Families were locked into debt. The fifth thing is professional credentials and middle-class social position. The belief that your degree constitutes financial security. In Weimar, Germany, the educated middle class suffered most. A professor's salary could not buy food for a week. In Venezuela, doctors and engineers emigrated because their skills stopped translating into a livable income within their own country. History shows survivors moved out of nominal assets early into physical things. They bought tools, art, or properties. Survivors also had access to foreign currency. In 1923, one American dollar was disproportionately valuable to a Berlin family. Finally, survivors had practical, tradable skills. Rural people who could grow food fared better than urban professionals. The pattern is clear. Survivors moved wealth outside the collapsing system or held assets with independent value. Every financial instrument built on a promise is only as strong as the system making it. Systems are not permanent. Trusting paper more than the system is the final error. Subscribe for historical clarity. I will see you next time.